Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10FX strategy at NatWest in the U.S. I'll be your host today, and as always, I'm happy to be joined by Paul Robson, who co-heads G10FX strategy with me over in London to talk about all things FX. It was another busy week this week, Paul, with developments in the Middle East and also some interesting developments from central bank on both sides of the Atlantic. So, Paul, as always, thanks for joining.
Well, thanks as always for the invitation. It does once again seem a very sort of timely podcast, as you mentioned, the Middle East very much in focus. And actually, I think maybe we should just start there this week, because it's clearly had a big impact on markets in terms of almost peak escalation and then de-escalation. I was just wondering what you're thinking here in terms of the Middle East.
Yeah, I think you sort of categorized it there really well, that you had this moment of potential significant escalation in terms of U.S. getting directly involved in the conflict, and then sort of an about face almost, as we saw at least a fragile ceasefire in place, and also the Trump administration maybe trying to push towards negotiations here. And we saw a big round trip in oil prices as well. We initially saw oil prices move up significantly, and they've since come down off of those peaks. In FX markets, I think the interesting thing is how the dollar has responded, because as you know, we've been talking about in this podcast over the course of several weeks and months, the dollar's position as the global reserve currency, global safe haven status, its sort of relationship with broader sentiment, risk sentiment, those relationships have shown signs of changing recently. And so maybe a really interesting piece of this from the dollar side during this escalation and then this sort of de-escalation. And what we saw was the dollar maybe showing signs of kind of reclaiming safe haven status. I think part of that was also because the market is likely still reading short of dollars. Certainly that's our view as well. The dollar continues to face downside pressure. And I think the market was short of dollars heading into this escalation. And so the dollar initially rallying during that period of heightened stress earlier in the week sort of was maybe the dollar maybe pulling back a little bit of that safe haven status that some relationships were showing that might be weakening here. So the dollar still, retaining some of its safe haven bona fides here. But as we've seen, the market sort of move towards a period of, okay, maybe we're in a point of de-escalation here. We've avoided the major escalation risk, I think, in the near term with, for example, the Strait of Hormuz closing. It looks like we're moving away from that and towards maybe a period where we can sort of begin or resume substantive discussions and towards a more negotiation stance. And so as we think about it from an FX side, I think that was really the interesting factor to watch, is how the dollar was responding and how that relates to its relationship with, as a safe haven currency. We saw some signs of it regaining safe haven status, but as we've moved away from that, it seems like the market's more willing to focus on dynamics related to the U.S. economy and the Fed. And I know we'll touch on that as in depth as we go through the pod, Paul. But I did want to bring you in just to ask you, how are you thinking about everything in the Middle East and how that's relating to global currency markets?
Yeah, I thought it was an incredible series of events where we sort of left last week and then through the weekend and de-escalation through the rest of this week. Clearly important. As you say, the focus, I think, very much on the oil price. I think that's when we look at cross-currency impacts, I think that's a ball that markets picked up and decided they wanted to run with. That was interesting. I think it's interesting how markets saw the impact on FX and rates, and I might just make a few observations there in a moment. But for me, with the US involvement, it does open up a wider array of possible outcomes at some point, which we don't know which one will ultimately happen. Before the US involvement, maybe it was more confined, and now it becomes less confined, and I think that's important. And I was actually thinking about Donald Rumsfeld's known knowns and unknown unknowns and the whole range between. And of course, these kind of events do increase the unknown unknowns when we look to the future. And I do wonder whether we'll get a twist or two for markets to try and digest. So I think we always have to guard against complacency when we think about the currencies, because the currencies did move, and it seems to be a preferred way for markets to see some of these events. And I think that's interesting when we compare the impact on, say, rates markets or equities. I think investors are more comfortable with looking at oil correlations, who imports, who exports, what kind of impact it will have, and they trade those. So things like something like Norwegian kroner against the Japanese yen seemed to be quite an early trade there. Australia against the yen. Whereas rates markets, I think, just a little bit more cautious, and how the impact of higher energy prices impacts central banks' policy outlooks in terms of the reaction functions. Maybe people are just a little bit less sure. So I think if we do get further moves in tensions in the Middle East, I think currencies will be the area to focus on. Of course, the Middle East wasn't the only thing making headlines this week. We had a lot of Fed speakers. Seemed to be there's a few differing views emerging on the FOMC, and obviously we had a couple of comments from Trump also on the chairman. And I was just wondering how you're thinking about it in terms of the Fed and any read across into the dollar, of course.
Yeah, it's really interesting because the Federal Reserve, the chair Powell, both last week at the FOMC press conference and this week in a series of congressional testimonies, laid out the case for a wait and see stance. And in both of those appearances, he made the case that it could be correct that tariff-linked inflation is not as strong as they fear it might be, or the pass-through is not as large, or that it takes longer and doesn't come through as clearly as some of the anecdotal evidence they're seeing suggests that it will. But Powell's view for a while has been, let's wait for the evidence before we consider making changes to the policy rate. And specifically, Powell has been mentioning wanting to see evidence over the summer, June, July, and August. And I think the message that Powell was trying to say was that they think that they are in a good position to consider waiting for additional evidence in one way or the other on inflation as we go through a period where most believe that if we're going to start to see tariff-related inflation, it will start to show up. Some members of the Fed leadership, specifically Governor Wallman and Vice Chair for Supervision Bowman, in the past week have staked out a different position than the chair. And I don't think it's necessarily a policy difference, but I do think that it's a bit of a confidence and evidence difference. Powell is in a wait and see stance because he wants to wait for the data to confirm or deny the hypothesis on inflation. Bowman and Waller took a frankly different stance, which is I think they've seen enough evidence to consider cutting the policy rate, and both of them effectively endorsed potentially cutting the policy rate as soon as July. I think, Waller and Bowman's views differ in some important ways, but I think one of the core things that they share that's different from Powell is I think they feel like they've seen enough evidence that tariff inflation is either not going to be as large as feared, certainly in early April during the height of Liberation Day tariff increases, but also they see if they feel quite confident, I think, that the effects of tariff inflation are going to be one time. They might be smaller, and they've seen important progress on services inflation, particularly services ex housing inflation, which has been an important piece of the puzzle for the Fed for a very long time. And so you have these differentiated views on the Fed, which has certainly been quite interesting at a time when you have the President of the United States obviously advocating for one side of that discussion, which is towards cutting the interest rate. Now, we think that Powell's view is going to win out here, that effectively the Fed's unlikely to be in a position to cut the policy rate as soon as the next meeting in July. But I think it's very clear that there are members on the FOMC who are becoming a bit more concerned about the potential for a labor market slowdown and more confident that tariff-related inflation is not going to be as large or as durable, as it appeared to be as recently as this past spring. And so it's very interesting that we've had these differentiated views. Now, you also mentioned the dollar, of course. Now, if the Fed is gearing up for a dovish pivot, and the market seems to be leaning that way, certainly pricing greater odds of Fed easing, given these differentiated views in some of these Fed leadership. Now, that would be, normally you would say, okay, that pushes us towards a more dovish potential steady state for the Fed. Again, that's not our house-based case here at NatWest, but If we're pushing towards something more dovish relative to the rest of the world, that tends to move these short-term rate differentials against the US and normally points towards a weaker dollar. And I think that would probably be the case here as well, where you say, we already have a bearish outlook for the dollar. We continue to expect the dollar to weaken. This kind of move in market pricing feeds into that. But what we should also acknowledge is that this relationship between front-end rates and the US dollar has actually weakened over the past couple of months. And if anything, if you look at the evolution of short-term interest rate differentials, what they've been telling us recently is the dollar looks almost maybe a little bit undervalued based on that metric, because US interest rates have risen relative to their peers, since the sort of depths of April Liberation Day, but the dollar has actually stayed lower. Now that for us, I think is emblematic of some of the structural challenges facing the dollar. But we should also acknowledge that if we're just thinking about it from a relative policy perspective, the fact that the Fed's been hawkish hasn't really been supporting the dollar. So we should consider that when we consider whether or not a dovish pivot by the Fed, if it does happen, ends up being negative. I do think it's a negative for the dollar. It sort of adds to potential concerns if the Fed does go down this road. Certainly very interesting this week to hear members of the Fed leadership staking out differences of opinion that I think really come down to this timing and confidence issue. So maybe we should move from here across the Atlantic, Paul. I do want to ask you about sterling here.
Yeah, before I get on to the Bank of England, I thought it was just listening to you there talking about the dollar and the Fed and the disconnect between yields and the dollar, which I think is, we both think, don't we, that it's important. And just seeing that weakness in the dollar as we ran up to the end of the quarter. So when we know that you sometimes get rebalancing flows for investors, and maybe that just shows that people are adjusting how they see the dollar in terms of asset allocation and hedging. So it'll be interesting to see whether, for me, the dollar weakness that we've seen recently actually persists once we get through the end of the quarter. I thought it's interesting you got that coincidence. Although the police say apparently that 9 times out of 10 they think it's a coincidence, but it turns out not to be. So we'll watch that space very carefully. In terms of the Bank of England, I thought we didn't hear or learn a lot new. I certainly think the Fed and the Fed speakers and the testimony was certainly more important for currency markets. We had a whole range of central bank speakers here in the UK. But the guidance was very similar to what was set out in the last policy meeting. Bailey the governor of the Bank of England, once again talked about gradual and careful reduction in monetary policy, that interest rates are still on a downward path. I think markets are always of that way of thinking. He did say a couple of interesting things later on in the week about weakening employment labour markets, and I think that's going to be crucial for the outlook. And ultimately, when we think about the impact on sterling later, that if the labour market continues to weaken, then markets might price rate cuts with a little bit more vigour, and unlike the dollar at the moment, at least, it might be more negative, and we'll certainly have to watch that. Certainly anecdotally, when I go around the UK talking to businesses about how they're seeing the outlook and how they're adjusting to higher national insurance contributions, minimum wages, higher costs, and if they aren't able to pass those on to consumers, then they'll have to cut employment, and it feels a very important point for the UK economy, and I think that will translate to being a very important point in the cycle for sterling. I think who's got the pricing power gradually shifting from workers or employees to employers. Obviously through COVID it shifted quite remarkably, and you got wage increases, for example, but the band seems to be shifting once again. The other MPC members, pretty similar. We had Green talking. She seemed to be a little bit more concerned about employment and growth, but then she was also talking about the persistence of inflation, and the Bank of England has that as their inflation, their primary mandate. So obviously if growth and employment is weaker for longer or more persistent, then interest rates will come down. But it's just the Bank of England remaining cautious. Ramsden, another member who unexpectedly voted for a cut, sounded a little bit more dovish, although he said his decision to cut rates was finely balanced. But he also said that terminal rates in the UK is probably quite well below 4%. So perhaps we didn't learn a huge amount, but the direction of travel, as it is actually for a lot of central banks, been slightly. I think that was the key takeaway from June. I think all central banks just sounded a little bit more dovish.
It's fascinating, as I listen to you talk about this sort of question about who has pricing power to pass through certain changes in fiscal policy, where does that end up hitting? I mean, that's the same theme that we're dealing with here in the U.S. as relates to tariffs, and I feel like that question of who ultimately bears the cost of tariffs, how much of it goes through to inflation, how much of it doesn't go through to inflation. If not a lot of it ends up coming through to inflation and companies eat that cost, then maybe it has differential effects where it's a less of an inflation hit and more of a growth hit. It kind of leans into that maybe more dovish version of events some Fed members are leaning towards. Of course, you could think about the exact opposite where companies are able to pass that through to consumers and it hits inflation harder. And so it sort of leans into this wait and see. So it's really interesting. We just have these sort of a very similar dynamic where central bankers are in a position where they are trying to figure out how businesses are able to incorporate some of these changes and whether or not it's going to be something that they need to deal with from the growth side more or from the inflation side. It certainly feels like there's sort of echoes of that idea in both themes that we were just talking about here on both sides of the Atlantic. So just wanted to talk a little bit about sterling as well, just to get your sense of how are you putting all of this together as it relates to the outlook for sterling here.
Yeah, so sterling dollar reaching 4.5-year highs, the highest level since the beginning of 2021. So that made the headlines. That's important. I think what's equally important to remember is that this feels like it's the dollar weakening rather than sterling outperforming. I know that maybe some of the newspaper headlines will concentrate on sterling rallies, but it's actually the dollar weakening rather than sterling doing particularly well. If I look at some of the FX crosses, so sterling against the euro, that's been a lot more stable over the last week. But it has stopped weakening, sterling weakening on the crosses. And this ties in with what we were talking about right at the beginning about Middle East tensions, because sterling can be sometimes a sort of fair weather currency. It needs people to be confident about the outlook for the global economy to then maybe position in sterling and pick up the benefits of higher interest rates when markets are more cautious about the outlook because maybe tensions in the Middle East rise, then sterling tends to underperform. So sterling did what it normally does. It weakened through the tensions, and as they eased, sterling came back a little bit. And I think that's right. And I think that when I look at other central banks, maybe just gradually easing, if I think about the ECB, you've got a euro dollar rallying, the exchange rate's more important for the ECB. Could they start turning a little bit more dovish by the time we get to the end of the summer? Remember, Lagarde said, sort of, see you after the summer. That was pretty clear that they're not going to be doing anything in the summer. And if we get these calm markets and currencies remain relatively well behaved, then maybe investors focus on where interest rates are highest, carry to vol ratios, as I would sort of talk about it in another context. So maybe sterling does relatively well. And if we get this continued weakness in the dollar, I think sterling can perform relatively well. So, a reasonable expectation maybe 140 for sterling dollar, but I don't think euro sterling does a huge amount. You mentioned fiscal risks a little bit in there in terms of what's been happening in the US, and I think that is the main risk around the UK and sterling. When we get into the autumn, then we've got a fiscal event, the budget, and if we think about this week, what was the other thing that was sort of maybe bubbling along under the surface, and that was, I think, the government here in the UK is struggling to get spending down. And so we had the NATO conference, governments committing to 5% of GDP defence spending. But we also had some focus in the House of Parliament about the welfare bill going through. And again, it just plays to that idea that come the sort of end of the year, maybe the UK's slightly fragile fiscal position undermines that recovery in sterling, but that's still a few months off, thankfully, and we'll enjoy the summer before we revisit those risks.
Yeah, thanks, Paul. A lot of good points there. And, as we talk about fiscal risk, certainly here in the U.S., they are plowing ahead. The Senate Republicans plowing ahead with their the Trump tax package. As we are recording this now, this bill is changing basically every single day. But, fiscal risks here in the U.S. are certainly front and center as well. As, we try and balance all of this together. We also have this potential big tax bill coming as soon as next week. I think the risk is maybe that it drifts a little bit later than that, but certainly we're watching these fiscal policy changes here in the U.S. as well. But I think that should be a topic for another day, and we should call it here. So, Paul, thank you very much for joining, and to our listeners, also thanks very much for listening. And if you enjoyed this podcast, consider giving it a like and also subscribing to our channel so you can get our latest content the moment it's released. Thank you very much.